bracket, right? Okay, but you also had other assets, all right? This year, you have to have more than $5 million before they would have estate tax, okay? But it was supposed to, most people thought, go back to $1 million for the one person, right? So in 2 years, what if it goes back to $1 million and you have $2 million or $3 or $4 million in your estate that you leave to a child? The IRA is a real troublesome vehicle because of the fact they have to pay ordinary income tax when they take the lump sum. Number two, it'll be subject to estate tax. And that could be 55%, right? So they get really, they would get nothing hardly. What, 10%? And so kids now, if they're going to take the lump sum and both parents die, it's a good time to take it because the tax bracket would be 35%. And if the estate is less than $5 million, then they don't have to pay any estate tax, right? Okay. So the other options they can have is stretch it out over their lifetime. Okay, when you stretch it out over your lifetime, they still control the investments on the money. If you annuitized it, okay, which means the insurance company, you assign control of the money over to the insurance company, and the kids would get a guaranteed income for life for 5 years, 10 years, 15, or 20 years. Those are the options that they have from the IRA after you die, after both spouses die. Did that answer the question?
So is a stretch IRA something that's defined at the time both parents are dead and the child inherits it?
Right.
I mean, we don't do anything now to make a stretch IRA.
No.
They do it.
Exactly.
Yeah,
stretch IRA would be determined by the inherited, the beneficiary.
So there'd be a primary beneficiary and a secondary beneficiary.
Right. Okay. Usually the primary is the spouse. The secondary contingent would be the kids. Doesn't have to be that way, but that's the way it usually is.
You can take a present, if you define this primary and secondary, then it is by definition a stretch IRA. Is that a correct statement?
No.
Well, no, not until it occurs.
Until it occurs.
Right.
Death. But
death occurs.
I'm saying that you have the conditions for a stretch IRA if you have a primary and secondary beneficiary already defined.
If it's a child.
Okay.
Yeah.
Well, but what you said was that it's a stretch if the child decides to take the withdrawals over a period of years.
Right, exactly. It's not something that you determine before you cannot determine it before you die.
Yeah. Okay.
But you would, you know, the financial plan would be that you would hope the child would not take the lump sum and not have any money left after taxes, because that was your hard-earned money, right? And you want to leave it to your kids. You would like for your kids to be able to maximize that money. And like John said, if you're taking a stretch IRA over their assumed lifetime, that money in there continues to grow, okay? So if it was $1 million of money that they were left, they might be taking 2% to start off with out of there. And as they get older, the amount goes up. And look at the growth of the money, though. It's phenomenal.
When both parents die and the remaining IRA goes to, say, 3 kids,
right?
Do you get 3 stretch IRAs?
You can. They would each have their option how they want to take the money. One could take it lump sum, one could take it 5 years, one could take it over their lifetime.
Okay.
Yeah. Yes, sir.
Can it not also be stretched beyond the children, the grandchildren?
Could it after the unless it's a particular type of non-qualified annuity, the stretch IRA normally would terminate after the child. Okay.
I thought there was
there are provisions
to go beyond.
that you can go beyond that.
But you have,
But
the
it's
person with the IRA has to define it has to define the beneficiaries and the sequence. And he doesn't have control over it once he dies, obviously.
yeah, it's a complicated estate planning tool that you can do, and you can do that with non-qualified money a lot easier than you could do it with qualified money.
If you had one and the primary person had the IRA died, the secondary person received it, the primary beneficiary, can that beneficiary convert it to a stretch IRA one more generation?
at the time that they receive the money, they have the options just like the children would have after the first beneficiary died. In other words, if you died and your wife got the money, then she could take it lump sum. Okay?
But is the question, can you redefine the
Yes,
beneficiaries?
yes.
I don't think you can.
No.
You can't.
No, actually
Your first beneficiary can't change the second beneficiary.
The second beneficiary can't change what the first beneficiary would be.
well,
I was of the impression that if it passed on,
okay,
and the primary beneficiary is now the owner,
right.
okay, then that person could redefine it. I'm gonna be there, I'm gonna have a primary, these are my primary beneficiaries, then there's another generation.
Yeah. To make that clear is that if I died and my wife gets the money, she becomes the owner, she can change the beneficiary. Yeah. She said, I don't like your kids. You know, I mean, you know, we had 50% of your kids, 50% of mine, now mine gets it all, right? It works both ways, so men could do the same thing.
Yeah.
If the wife died. You know? Now, would you do that? Who knows?
Well, the widow remarries, that was a good example. A widow remarries with to a person with kids, you could change them,
You can.
and then they will distribute it out of the
Yeah.
Of course, those kids get pissed off.
Now see, on a non-qualified annuity, which John was,
Original kids get
yeah.
pissed off.
On a non-qualified annuity, which John was talking about, on the Lincoln plan that you can get tax-free income, also on the non-qualified annuities, you can specify and determine how you want that money paid out when you die. The owner can. I mean, it can be like on mine, it goes to my wife, I die, we both die, it goes to the kids over 20 years. That's like a non-qualified annuity. Or like a life insurance policy. You can determine the beneficiary as you would have in your financial plan. You don't want to give $1 million to a child, right? In lump sum? Probably not. Even if they're 40 or 50. Right? Or 60. No. Well, you would like your hard-earned money to go to your children and go to them over a period of time so they would have a regular income stream over a long period of time. That's why you do the stretch IRA. That's why you would like to do the stretch IRA. But the non-qualified money, you can determine the stretch ahead of time. You see, with qualified, you cannot. Okay, John?
That's why I asked Bob to come with me.
Well, excuse me. After 40 years, you learn a lot by experience. But also, I appreciate being here today. One of my good friends and clients is Michael Cochran, who has more patents at TI, I think, than anybody. Anyway, he's alive and well. Said kidney transplants, but he shows up working every day. Cochran Associates. He's a great guy. Thank you.
There's a lot of advantages to having a non-qualified. You can design it to fit your needs. Now you can put it like one device is the Lincoln non-tax annuity, where all your money coming out of it will be non-taxable. Or you can put it in something like MetLife, where you can take distributions from it, but then after 10 or 15 years, if something happens to you, the original amount of money that you put in is still there through a life insurance policy. So you can pass it on to your spouse. And she can keep taking money out for 10 or 15 years. And if something happens to her anywhere along the line, the value of the account will still be there, the original value. And after you go through the market that we went through in the last couple of years, and it's still not back up, if you're back up to 80% of what you were a couple of years ago, I think you're doing pretty good. I'm becoming a lot more risk adverse, and there's a lot of different instruments out there that can help you. Even if you just put your money into bonds, like I said, there's PIPCO bonds, there's different vehicles out there that you can use to fit your needs. Because sometimes you might need tax-free money. Sometimes you want to not go ahead and keep the money in some other vehicle to get a higher rate and just use your savings or something to live on for a while these other funds keep growing and growing. So that's an area that, you know, if you haven't looked at, you know, to really get a good financial plan, figure out where you're at, that's something that, you know, to look at. Now, go ahead and, any questions?
The RMD, somebody asked the previous speaker and they answered, and I think he was wrong.
Okay, which one?
When you reach 70 and a half, there's a percentage that you're supposed to take. Doesn't that percentage step up every year?
Yes.
Yes.
Yeah.
It's like, yeah.
You said you take that same distribution every year, not.
No, it's actually, it's IRS determined formula, how much you take out of there, but it's not the same.
Yeah.
Matter of fact, it starts out, I'm taking distribution myself, and at age 72, distribution is about 4.3%, okay? But when I get to be 80, it's about 6.7%.
That's what I
So it goes up every year based on your age.
And
because
it's based on the new value at the end of the previous year.
Exactly.
Yeah.
There's two variables there, what I'm hearing you say.
Yeah, right.
Not only the percentage, but the total amount that it's worth.
Right.
Yeah, the percentage is based on the account value at 12/31 each year, of last year that you take this year.